Professor Battalio, we'll have you go first. And thank you again for coming today and for your work.
Good morning. Chairman Levin and Ranking Member McCain, thank you for inviting me to testify today. It's an honor to have the opportunity to present my views on conflicts of interest in U.S. equity markets to the Senate Permanent Subcommittee on Investigations. My expertise is the relationship between order flow inducements offered by dealers and exchanges and the quality of trade execution. Before discussing my current research with Shane Corwin and Robert Jennings, I'd like to provide a bit of context. Orders used by retail investors can be broadly classified into two categories. Investors who want to trade quickly at the best available price use marketable orders. These orders demand or take liquidity from the market. Investors who are willing to buy or sell stock, but not at the prices that are currently prevailing in the marketplace, use non-marketable or standing orders to express their trading interests. Non-marketable orders do not immediately execute when they arrive in the market. Exchanges use electronic order books to keep track of their non-marketable orders, and they typically use price-time priority to determine which non-marketable order trades when a marketable order arrives. The non-marketable orders resting on the electronic books make or supply liquidity for other market participants. Several exchanges use make or liquidity rebates to attract non-marketable orders. A make rebate is paid to an investor or her broker when their non-marketable order trades. To fund the make rebates, the same exchanges charge marketable orders a take fee when they trade with non-marketable orders. As a result of competition, exchanges offering high make rebates also tend to charge high take fees, and those offering low make rebates tend to charge low take fees. The incentives created by the maker-taker fee structure suggest marketable orders will tend to be first routed to venues that have low take fees and thus low make rebates. As a result, non-marketable orders on high fee, high rebate venues are likely to trade last at a given price and thus can miss out on profitable trading opportunities. All else equal, this suggests that the likelihood that non-marketable orders trade is lowest on the exchanges with the high make rebates. NASD Notice to Members 01-22 states that brokers must take into account differences in the likelihood of execution when determining where to route non-marketable orders, and that brokers must not allow inducements to interfere with the duty of best execution. The conflict of interest associated with make-take fee schedules arises from the fact that most brokers don't pass fees and rebates directly through to their customers, but instead charge fixed commission rates that reflect fees, rebates, and other costs of doing business. Thus, while investors prefer that their order be routed to the venue offering the highest possibility of trade, a broker may have an incentive to route the order to the venue offering the highest liquidity rebate. It may seem that economics and competition should align the incentives of a broker and its customers. However, this alignment of incentives is hampered by an important agency problem. Brokers that maximize rebates may be able to charge lower commissions. If the investor chooses brokers based primarily on commissions, perhaps because they lack the sophistication and/or the necessary information to fully evaluate execution quality, it may be profit maximizing for brokers to focus on liquidity rebates rather than the likelihood of execution when deciding where to route their non-marketable orders. Unfortunately, investors whose orders don't execute don't receive the benefit of the low commission. In our paper, we examined two issues. We begin by exploring whether make rebates appear to influence the routing decisions of retail brokers. We present evidence from SEC-mandated Rule 606 filings that 4 popular retail brokers route non-marketable orders in a manner that's consistent with the goal of maximizing make rebates. Our Rule 606 data are from the fourth quarter of 2012, but subsequent Rule 606 filings suggest these brokers have not significantly altered their routing of non-marketable orders. After establishing that rebates appear to impact order routing decisions of some brokers, we next analyzed the relationship between make rebates and several measures of execution quality, including the likelihood that and the conditions in which non-marketable orders trade. Our analysis makes use of a proprietary data set of non-marketable orders that represent about 1.5% of average daily volume and a publicly available database that contains all trades and quotes. As hypothesized, we find that non-marketable orders routed to venues with low make rebates are more likely to trade faster, and suffer less adverse selection than non-marketable orders routed to venues with high make rebates. Our results suggest that when deciding where to route non-marketable orders, situations frequently arise in which brokers must decide whether to maximize the likelihood of an execution or to maximize make rebates. Thanks for the opportunity to discuss my research with Shane and Bob today.
Thank you very much, Professor Battalio.